Hi everyone, hope you to be doing well. Let's start with the fundamentals of accounting. So the first thing you need to understand is what is accounting. Think of accounting as the business's diary where you keep track of all the money coming in and going out. Its purpose is basically to see how much money the business has owned and earned. Okay? Moving further, we have basic accounting ideas that we need to have good knowledge about. The first one being business entity concept. Now, this one says that we have to treat the business and the owner as separate. Now, what does that mean? It means that the business's money is not the owner's personal money to spend. Then we have the dual aspect concept, which more or less says that every action has an equal and opposite reaction. In accounting terms, every transaction affects two accounts. For example, buying a computer means you spend cash, so cash decreases, but you are gaining the asset, so the computer asset increases. Okay, so it has two aspects. One is the cash, and the other is the asset that you're acquiring or giving away, right? The next we have is going concern concept, which basically just says that we have to assume that the business will keep running for a long time. Next, we have accrual concept, which states that record transactions when they happen, even if the money has not changed hands yet. Then we have consistency concept. Now this method simply says that use the same method for comparison every year, every time, for clear comparisons rather than changing your methods and getting different results. Okay. Next, we have the prudence concept, which states to be cautious, record expenses and losses as soon as they are expected, but only record income when it's certain. Now next we have the accounting equation, which is assets are equal to liabilities plus owner's equity. Now assets are things the business owns, like cash, equipment, buildings, etc. Then we have liabilities. This is the money that business owes, like loans, bills, etc. And then we have owner's equity, the owner's share of the business, like assets minus liabilities. The next concept we need to understand is of double entry system. Now, the principle states that every transaction has two sides, a debit and a credit. Think of it like balance scale. Everything must balance. Okay? For example, buying a new phone for the business. A debit is added to equipment and credit subtract from cash. Next, we have financial statements. Now, there are three types of statements we need to know about. The first one being the income statement. It's like a report card for the business showing how much money it made and spent over time. Then we have balance sheet, a snapshot of what the business owns and owes at a specific moment. Next, we have cash flow statement, a diary entry showing the flow of cash in and out of the business over time. Moving on, we have recording transactions. The first one being the journals. The first place transactions are written down. Then they are moved to the ledgers, where all the detailed accounts live. Finally, we have the trial balance, a check to make sure all numbers add up correctly. Next, we can learn about some common accounting terms such as revenue, which is money earned from selling goods or services. Expenses, money spent to run the business. Capital, money the owner puts in the business. Drawings, money the owner takes out for personal use. Debtors, people who owe money to the business. Creditors, people the business owes money to. Next, we have the accounting cycle, which tracks down the journey of a transaction. Now, we start with identifying transactions. We spot which events are financial transactions. Then we record these transactions. We jot down transactions in the journal. Then move general entries to right ledger accounts, from where we move them to trial balance to make sure everything balances and the right hand side is equivalent to the left hand side. Then there comes a part where we have to make adjusting entries, and we adjust for any income or expense not yet recorded. Then, finally, we move towards preparing the financial statements. We create income statement, balance sheet, and cash flow statement. Now, lastly, we do the closing entries. We wrap up temporary accounts to start fresh next period. We also need to understand that why is accounting so important? So there are different reasons which make accounting really important for the business, such as it helps the business in making smart choices, so it helps in decision making. It keeps the businesses following the laws, so it helps with the legal compliances. It shows how well the business is doing, so it helps in performance evaluation of the business. It also helps the business to plan future, so for financial planning, and it gives a clear picture of the business's finances, so it provides transparency in the business.